Across global financial markets, billions of data points are generated every second. For decades, institutions and retail traders have distilled this complexity into one specific metric, the 200-day simple moving average. This chart illustrates a standard market narrative. A stock drops, touches this blue line, and ricochets. Investors credit this metric with providing dynamic support. Panning forward, the pattern repeats. The market collapses and halts its descent precisely at the intersection of the indicator. This accuracy forces a question. Does an underlying macroeconomic law anchor asset prices to this specific threshold, or are we witnessing a behavioral illusion? To find the answer, we look at the participants. A critical mass of institutional algorithms, hedge fund managers, and retail traders all anchor their biases to this exact coordinate. Institutional herding around psychological numbers is a historical constant. It predates modern computerized trading, rooted in the human tendency to seek collective safety. Because of this heavy reliance, traders treat the 200-day moving average as a surgical execution trigger, a buy signal for timing the exact bottom. However, the underlying mathematics actually suggest otherwise. To understand the indicator's true utility, we must decouple its mathematical reality from the psychological distortion it creates on the charts. We begin with the formula. A simple moving average averages historical closing prices over a specific period, assigning equal mathematical weight to each day. This creates a rolling window where the oldest price point drops out as each new daily close is recorded. Structural lag is the unavoidable consequence of this equal weighting. By design, the line trails behind current price action, anchored to 200 days of history. This lag is obvious during a market reversal. When prices hit a hard bottom and sharply recover, the 200-day moving average continues sloping downward for weeks. Empirical backtesting confirms the cost of this delay. When testing major indices like the Dow Jones Industrial Average, we can measure the efficacy of pure technical crossover strategies. The test parameters are direct. Execute a buy order the moment the price crosses above the 200-day line, and execute a sell order when it crosses below. Trading purely on long-term simple moving average penetrations yields negligible outperformance compared to a standard buy and hold baseline. Traders often find themselves whipsawed by these signals. The inherent lag generates entries and exits long after the trend has moved, trapping participants on the wrong side of the market. The math guarantees these delayed signals, making the 200-day moving average structurally incapable of pinpointing market bottoms. This leaves us with a paradox. If the formula is slow, why does the price still occasionally reverse off this line with such accuracy? To find the answer, we have to look past the line chart and examine the market microstructure, the high-frequency architecture where trades are matched. Behavioral finance identifies this as anchoring bias. In complex environments, participants fixate on arbitrary reference points to simplify their decisions. This chart shows the financial order book, where anchoring bias triggers a self-fulfilling prophecy. Because so many traders expect a bounce at this level, they place their orders there, creating the very support they anticipate. Algorithmic execution triggers and retail stop losses are explicitly programmed to fire at this coordinate. Incoming downward momentum hits this wall of pre-programmed buy orders, and the sheer density of this clustered liquidity forcibly deflects the price upward. The support holds because of coordinated behavioral reaction. It is a product of belief and liquidity clustering rather than a fundamental valuation of the asset. The 200-day moving average is an artificial floor, a phantom barrier sustained by the critical mass of market participants who assume it exists. Any technical indicator's viability depends on the environment. To see where the self-fulfilling prophecy breaks down, we must test it against different market regimes. This chart divides market history into distinct phases. We start with Regime A, a clean, upward trending bull market, characterized by low volatility and steady accumulation. During these accumulation phases, the 200-day moving average acts as a remarkably clean, consistent floor. The self-fulfilling prophecy holds here. Positive macroeconomic conditions support the behavioral bias to buy every dip. The environment changes in Regime B, a phase of distribution marked by high volatility, sideways movement, and macroeconomic uncertainty. The indicator fails in this environment. Price action slices back and forth through the 200-day moving average with no respect for the boundary. In distress regimes, institutional repricing based on economic fundamentals completely overwhelms technical behavioral anchoring. Traders using the line as an execution trigger during these phases suffer heavy capital drawdowns due to constant false signals. The indicator is blind to context. Its effectiveness is dictated by the underlying market regime rather than the formula itself. Stripping away the microstructure reveals a clinical view of the moving average. This line divides the chart into two distinct zones. Investors should stop using the 200-day moving average as a surgical execution trigger to catch falling prices. Relying on this metric for precise entry timing guarantees exposure to both mathematical lag and whipsaw risk. Professional application treats this indicator as a binary macro trend filter. When price action sustains in the zone above the line, the prevailing regime favors long-biased trend-following strategies. Conversely, when the price sustains in the zone below the line, the regime dictates defensive or mean-reverting strategies. The moving average defines the boundaries of the current battlefield. It provides the situational awareness required to understand which regime currently dominates the market. Surviving the markets requires using the 200-day moving average to understand the environment, rather than using it as a blind trigger to enter a trade.